Digital asset management, as it becomes more complex and positive, fosters economic development and prosperity. Ether recently broke through the $4,000 barrier, while Bitcoin, the world's most famous cryptocurrency, recently surpassed another all-time peak of $63,000. Meanwhile, news articles of digital artwork fetching exorbitant premiums in the form of non-fungible tokens abound, and Dogecoin remains on a roller coaster ride after Doge father Elon Musk's presence on Saturday Night Live. If you agree with it or not, blockchain is widespread. Despite this, not everybody is persuaded. Janet Yellen, the newly named Secretary of the Treasury of the United States, openly doubted the validity and stability of cryptocurrencies as a store of value. After all, the most recent crash of the Bitcoin bubble happened just 3 years earlier. Following a meteoric increase to $20,000 in 2017, the commodity tanked in 2018, eliciting comparisons to tulip mania. Owing to their fervent devotion to this novel, untrustworthy, and mysterious technology, Bitcoiners have been dubbed cultists. However, do not be misled. Blockchain technology is not just for programming enthusiasts and crazy billionaires such as Elon Musk. From JP Morgan to PayPal, real Wall Street aristocrats and Silicon Valley stalwarts have been amassing vast amounts of Bitcoin. Bitcoin's total numerical value in circulation has surpassed $1 trillion. The majority of large financial companies, including investment banks and payment processing, have already backed Bitcoin, and institutional buyers have increased their participation. Bitcoin has grown in prominence as a part of the global financial system. Simultaneously, Bitcoin has become a regulatory gray ground over the last decade, as many compliance authorities have pieced together a patchwork of blockchain regulations. In certain circumstances, this patchwork approach is inadequate to persuade institutional buyers, while some of the most fundamental aspects of cryptocurrency strategy remain unresolved. Are Bitcoins, for example, called shares or stocks? Naturally, it depends on who you ask. One of the most pervasive myths about Bitcoin, and blockchain in general, is that the economy is unregulated and rife with fraud artists, outlaws, and crooks. Clearly, this is not the case. Any enterprise that does business with customers in the United States or otherwise is subject to regulatory requirements and regulations that could extend to digital properties. Given that we are on the brink of a modern, disruptive technology, it is likely that no infrastructure for cryptocurrencies has been designed specifically. Separate laws, though, extend to different practices in the areas of customer security, anti-money laundering, and anti-fraud. To ensure that the laws governing their industry are followed to the letter, crypto businesses should work with law firms to define them. The new crypto rulebook was pieced together during the last decade when enforcement caught up to volatility. This, though, is subject to change. Gary Gensler's nomination as the next chairman of the Securities and Exchange Commission, or SEC, indicates that the current administration would see digital assets favorably and work for agreement. Gensler is a former Commodity Futures Trading Commission commissioner who has taught classes at the Massachusetts Institute of Technology on blockchain innovations and cryptocurrencies. Gensler previously said that he will wait until the conclusion of Yellen's crypto analysis before enacting a digital currency regulatory plan. Meanwhile, Congress is investigating the matter. Last month, legislators introduced legislation to establish a working group composed of industry analysts, SEC and CFTC officials to investigate the existing legislative and regulatory process covering digital properties. It is difficult to foresee the potential appearance of cryptocurrency laws and industry frameworks. Nonetheless, politicians are becoming more knowledgeable and proactive as they recognize the critical nature of effectively protecting customers, stimulating creativity, and promoting economic balance. With a slew of crypto companies springing up in this perplexing regulatory climate in recent years, retail investors must consider the risks to minimize while selecting a partner with whom to entrust their digital properties. It is important to understand how the company works, and this information should be readily accessible on their website and cross-referenced with that of the regulator. Additionally, since no two businesses are alike, each business model must be recognized. While the underlying principle of paying yield can seem to be identical, the risk profile can be somewhat different. If a company is unsure about how it runs and generates revenue, this can raise red flags, and if their expenses are far greater than competitors, I think it is critical to examine why. Always take the time to decipher the fine print. While certain businesses can prefer to operate in jurisdictions with low regulatory pressures, doing so at the cost of trust and long-term business is counterproductive. Any business worth its salt would approach regulators cooperatively and positively. It's a difficult world to manage, and it can be costly for entrepreneurs, but it's just part of the cost of long-term value creation. To remain at the cutting edge of the blockchain revolution, cryptocurrency lenders must accept the impending regulatory reform and embrace the potential to interact with regulators. Investors may look for companies that place a premium on integrity, accountability, experience, and equity in their business relationships.